Imagine waking up, checking the paper, and feeling like a financial tycoon because you followed an investment tip from your local barber. That illusion shattered for an entire nation as $200 billion evaporated into thin air in a single afternoon. To see how that wealth vanished, we have to look back to 1922. The First World War was over, and the American economy was humming. Factories that spent years churning out tanks retooled to pump out consumer goods, shiny new toasters, powerful vacuum cleaners, and modern refrigerators. Industrial innovation moved at breakneck speed. Henry Ford implemented the moving assembly belt, and the time it took to build a Model T dropped from 12 hours to 90 minutes. Cars flooded the streets, pulling industries like oil, steel, and rubber along with them. Cities wired up for electricity, and Americans discovered the radio. By the year 1929, 10 million homes were tuned in, listening to Al Jolson and soap operas through glorious AM fuzz. The public mistook this rapid, tangible progress for a guarantee. They assumed that because factories were efficient, financial growth would be endless and automatic. Buying these new luxuries required cash most people didn't have. The financial sector responded with buy now, pay later installment plans. Banks were so eager to issue credit, they offered loans to practically anyone with a pulse. Wall Street applied this same logic to the stock market through the margin loan. It allowed an average person to buy $100 worth of stock with only $10 down. The remaining $90 was borrowed directly from the broker. Investors ignored the risk of that $90 debt because of a collective belief that stocks only went up. As the asset value climbed, the borrowed money felt like a technicality rather than a liability. Margin debt changed the nature of the market. It transformed Wall Street from a place of business investment into a Disneyland for adults, fueled by borrowed confidence. Psychology eventually detached from economic reality. People stopped looking at company revenue or business models. As long as the line on the chart pointed upward, the vibes of the market were enough to keep the money flowing. At the peak of the mania, working-class citizens were regularly pitching stock investments to the elite. In one instance, a hotel bellboy successfully advised a Vanderbilt to dump his railroad holdings and move his wealth into pencils. Corporate executives exploited this optimism by creating holding companies. These entities were designed to own other holding companies, which in turn owned nothing at all. They had no factories and no products, just layers of speculation and pure air. Economist Roger Babson tried to sound the alarm, publicly warning of an impending crash. Wall Street's response was to ignore him, buy more stock, and ask the jazz band to play louder to drown out his voice. When optimism becomes so overwhelming that it actively silences mathematical warnings, the floorboards will eventually break. Reality eventually collected its debts. On October 29, 1929, Black Tuesday, the music stopped. The stock market performed a flawless 10-meter dive straight into concrete. Panic erupted on the trading floor as ticker tapes spat out endless red numbers. In a matter of hours, $200 billion in wealth, real savings and life dreams, vanished. The violent shift from greed to absolute terror exposed the inherent worthlessness of a market built purely on speculation. The crash triggered a devastating chain reaction. Because so many shares were bought on margin, brokers immediately issued margin calls to their investors. The math became a trap. Brokers demanded the immediate return of the $90 they had lent out, but the investors had no cash. Their $100 paper asset was now worthless. Terrified investors defaulted on their brokers, who then defaulted on major banks. This chain reaction dismantled the entire American credit system in a matter of weeks. Terror spilled onto the streets as the public realized their local banks were holding massive amounts of worthless Wall Street debt. Anxious crowds surged against bank branches. These bank runs were a desperate attempt by families to claw back whatever cash was left. Citizens banged on locked doors, only to discover the vaults were empty. Their life savings were gone. The fallout went global. International trade dropped by half, leading to a decade defined by dust and widespread hunger. The crash of 1929 teaches a timeless lesson. Whenever society decides that wealth can be printed from thin air, the foundation will eventually collapse. Keep an eye on your investments, and if you get a hot tip from a shoeshine boy, maybe just hold on to your cash. Thanks for watching Irony Economics. Hit that like button, subscribe, And let me know in the comments which multi-billion-dollar disaster we should decode next.